Hi, everyone. Welcome to CFI's Economics for Capital Markets course. My name is Andrew Liu, and I'm the Director of Capital Markets here at CFI. My purpose in developing this course is not to talk about classic micro or macroeconomic theory, but rather to focus on the practical side of economics so as to equip you for a career in the financial markets. In this course, we're going to start by exploring economic events and how to distinguish between economic indicators and economic releases. Then we'll move on to central banks and how they conduct monetary policy. We'll go through a case study as well as go over the largest central banks in the world and their key policy measures. Afterwards, we'll dive deeper into economic indicators, and we'll also point out the ones that you should be familiar with. Later in the course, we'll discuss how markets react in an ideal world versus how they react in the real one. And we'll wrap up how market participants use and trade these economic indicators. Throughout this course, you'll be watching video lectures, participating in interactive exercises, and applying your knowledge in case studies. At the end of the course, you will take a qualified assessment to test what you've learned. Later courses will continue to draw on the main concepts taught in this course, so it's important to have a solid understanding of this material. Speaking of material, we've got a lot of ground to cover, so let's get started.
So on to the first topic, and that's economic events. Broadly speaking, economic events are news that tend to move markets, and as I alluded to earlier, both the buy side and sell side care most about how and when markets will move in order to make their investment decisions. So what specifically is an economic event? I like to classify economic events as the release of economic indicators or economic releases to the general marketplace. In theory, the information should be made available to all market participants at the same time. However, in reality, there can sometimes be leaks from a variety of sources. But for the point of our discussion here, let's just assume that information is perfect and that all participants receive the information at the same time. Economic indicators tend to be more objective and generally have some sort of numerical representation. Examples of economic indicators would be something like GDP, Gross Domestic Product, or CPI, Consumer Price Index, a measure of inflation, or even a central bank rate decision. Economic releases, on the other hand, tend to be more subjective and would be news-based. These sort of economic events may require more of a deep dive to interpret the tone of the speaker or the message between the lines. An example would be the chair of the Board of Governors of the Federal Reserve Board, or the president of the European Central Bank speaking to reporters in a press conference. We will go into more detail on both economic indicators and economic releases in later slides. While economics is key to finance, micro and macroeconomic theories don't move markets by themselves. Traders, investors, and speculators need something real-time so that they can quickly formulate investment strategy, time their trades, and also use market volatility or lack thereof to make bets. Economists also need live data to update models and forecasts. All of these inputs come from economic events. To use one of my favorite quotes, in the long run, we're all dead, by John Maynard Keynes. We'll talk a bit more about him later when we discuss monetary policy. Economic events aren't always 100% accurate, but in a perfect world without any other overarching news, geopolitical tensions, terrorist incidents, or trade wars, without any conflicting news or data, without any specific industry news, or without any security-specific news such as earnings, credit upgrades or downgrades, or analyst forecast changes, economic events will drive the market. The foreign exchange, FX, and fixed income markets tend to react more directly to economic news than the equities or commodities markets. Equities markets are dependent on specific company and industry fundamentals, while the commodities market depend largely on more geopolitical and weather events. As we mentioned before, economic events can be both qualitative and quantitative. Both are equally relevant. Figures don't lie, but they're often open to interpretation and adjustment or modification in the future. Subjective or qualitative releases often require a deeper dive. And there are some economic releases, such as Purchasing Managers Index, or PMI, which take a qualitative measure, business sentiment, and quantify it as an index, which is an objective figure. Now you may ask where we get all this information from. Many of these economic events are from official agencies or sources, but there are also economic events from quasi-official or even private entities, such as the University of Michigan, Case-Shiller, or ADP. This is important for us when we consider the source of the economic news. Let's go back and focus on economic indicators for a moment. As you will recall, economic indicators tend to be more numbers-based. So the numbers generally fall into three measures. The first of which is volume. That's generally a quantity such as barrels of oil or numbers of homes sold. Second type of number we'll see is price. And that's a market price of that thing, say the price of a barrel of oil or the consumer price index. Lastly, we'll see the market value of something, say production of oil over a year or a set of interest rates. The relationship between these three types of figures can be captured in a very straightforward formula, where volume times price equals value. Other things to consider when looking at economic indicators would be whether the figure is absolute, whether it's an index, or whether it's a time series, which means that it changes over time, say year over year. Lastly, many figures use moving averages and or seasonal adjustments to smooth out the data and to take out erratic moves. Economic indicators can be largely classified into three broad categories based on the expected time frame the specific indicator is referring to, namely data from the past, the present, or potentially from the future. For economic indicators that provide an expectation of what's to come, we call those leading indicators. These indicators are any economic factor that changes before the rest of the economy begins to go in a particular direction or foretell something in the future. Examples of these would be, say, confidence surveys, housing starts, or durable goods orders. All three of these indicators give market participants and economists a sense of what the economy may look like in the future. For economic indicators that provide indication of what's happening now, we call those coincident indicators. These indicators measure the current economic state and give timely evidence of how the economy is doing. Classic coincident indicators might include weekly employment figures, workers' earnings, and auto sales. Lastly, for economic indicators that give confirmation of what's already happening, we call those lagging indicators. While you may ask why we would want to drive while looking in the rearview mirror, lagging indicators are useful to validate some large changes in economic policy or to disprove the effect of said economic policies. Sometimes economic indicators are lagging simply because of the time involved to gather the required value or data. Examples of lagging indicators include gross domestic product, GDP, or consumer price index, CPI. Again, not to worry if these examples are foreign to you, as we will drill down deeper into the economic indicators we touched on above, as well as many others later on in this course. In addition to understanding the economic indicators and economic events in general, it's important to discuss how the market classifies the sentiment of these events. You may often hear people talk about bulls, bears, doves, and hawks, so I think it's important to comprehend what these people mean when they use these terms. Firstly, bulls and bears. They're used to describe how markets are doing or how investors and analysts view the broader economy, the markets, specific asset classes, or even a market trend. A bull market is a market that is appreciating and implies that the market will continue to go higher. Bulls are people who continue to be optimistic. A bear market is the opposite. The market is falling and may continue to decline. Bears are people who think things will get worse, or pessimists. Hawks are people who favor less stimulus and higher policy rates in order to keep inflation in control, less concerned with economic growth. Higher policy rates are referred to as being tighter as they restrict growth. Doves are the opposite, meaning someone who prefers lower policy rates in order to drive up economic activity and employment. They're less concerned about possibly inflationary pressures. Centrists are those who sit in the middle. Central bankers who are centrists are sometimes referred to as being moderates and tend to base their decisions on the most up-to-date economic data from their respective jurisdiction. One other thing to keep in mind is that there's a lot of economic indicators and economic releases that come out every day. And these economic releases and indicators run the gamut from the most important top-tier news to some things that are so niche that it wouldn't impact the average person in the market, such as Swiss watch imports change year over year, or Ugandan bill auctions, or the CPI for Puerto Rico. Here's a list of some of the more important events that you should keep track of.